Before you buy silver in 2026, you need to hear this, because right now something very predictable is happening. People are rushing into silver again, not slowly, not cautiously, but emotionally. They're seeing prices rise. They're hearing predictions everywhere, $100, $200, even $500 silver. And for the first time in years, they feel like they're early, like they finally found the opportunity before the crowd. But here's the uncomfortable truth. This exact moment, it has happened before. And almost every time it does, most people make the same three mistakes. Mistakes that don't just reduce profits, they quietly erase them. I'm talking about losing 20, 30, sometimes even 50% of your gains. Not because the market moved against you, but because you bought the wrong type of silver. And the worst part? These mistakes don't look like mistakes when you're making them. They feel smart, they feel safe, they feel like exactly what you're supposed to do. But in a bull market, what feels safe costs most. So before you buy a single ounce of silver in 2026, watch this carefully, because the difference comes down to avoiding just three traps. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. Now let's zoom out for a second, because silver isn't just going up randomly. There are real forces behind what's happening. Silver sits in a very unique position. It's both a precious metal and an industrial metal. It's influenced by two powerful forces. On one side, you have investors, people buying silver as a hedge against inflation, currency devaluation, and uncertainty. On the other side, you have industry, solar panels, electric vehicles, electronics, medical equipment. Modern technology is becoming more dependent on silver every year. And here's where it gets interesting. Demand is rising, but supply? Not keeping up at the same pace. Mining production hasn't exploded. New discoveries are harder to find. And bringing new mines online takes years, sometimes decades. So you end up with a simple imbalance. More demand, limited supply. That's the foundation of a bull market. But bull markets don't just create opportunity, they expose mistakes. When money floods into a market, people stop thinking clearly. They start chasing. They start overpaying. They start buying things that feel right, instead of things that actually perform. And that's exactly what's happening right now. Let me show you how this usually starts. You decide you want to buy silver. You do some research, you learn about coins and bars, then you come across something different. A coin that looks special. It's older, it's rare, it's graded. It comes in a protective case. The description pulls you in. Limited mintage, collector grade, historic significance. Suddenly, this doesn't feel like a basic purchase. So instead of buying a simple 1 ounce silver round, you spend 3, 4, sometimes 5 times more on a collectible coin. And you walk away thinking, I didn't just buy silver, I bought something valuable. But here's the reality most people don't see. That coin might contain 1 ounce of silver. If silver is $80, the metal inside is worth about $80. Everything else? That's the story. The rarity, the grading, the packaging, the emotional appeal. And here's where the trap becomes dangerous. Because in a bull market, the market doesn't reward stories. It rewards metal. Think about who actually drives demand during a silver bull run. It's not collectors, it's manufacturers, it's industries. Large-scale buyers who need raw silver. They don't care if your coin is graded. They don't care about history. They care about ounces. So when silver doubles, generic silver doubles with it, but that premium you paid, it lives in a completely different market, a collector market. And collector markets don't always move with industrial demand. In fact, during bull markets, collectors often pull back. They wait. They become cautious. Which means that premium you paid might not increase. It might stay flat. Or worse, it might shrink. So imagine this. Silver goes from $80 to $160. A massive move. Your generic silver, you doubled your money. But your $400 collectible coin, maybe it goes to $450, maybe $500. You didn't double your investment. You barely moved. And when you try to sell it, you realize something painful. You didn't buy silver. You bought something else entirely. So here's the rule you need to remember. If your goal is to profit from a silver bull market, don't pay for stories. Don't pay for rarity. Don't pay for presentation. Because when momentum kicks in, none of those things matter. Only the metal does. Now, that mistake is common, but it's not the most common. The next trap? Almost everyone falls into it. In fact, there's a very high chance that if you already own silver, you own this exact type, and it feels completely safe, completely logical, which is exactly why it's so dangerous. Let's talk about government coins. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. These are the coins everyone recommends. They're official, recognized worldwide, backed by governments. And because of that, they feel like the safest choice. But here's what most people don't realize. In a bull market, these coins become expensive. not because of the silver, but because of the premium. Right now, when demand spikes, dealers raise premiums aggressively, and people still buy them because they trust them, because they don't question it. But here's the math. If silver is $80 and you're paying $120 for coin, you're paying a 50% premium. That means half your money isn't buying silver, it's buying the form. And that creates a problem, a big one. Silver has to move significantly. Just for you to break even, silver has to rise from $80 to at least $120 just to get your money back. That's a 50% move. Before you make a single dollar in profit, now let's go one level deeper. Premiums don't stay high forever. They expand when demand is high, and they contract when the market cools. During the excitement phase, dealers raise premiums, people rush in. But later, when things calm down, when demand slows, premiums drop, sometimes sharply, which means when you go to sell, you're not getting that same premium back. So you lose money in two ways. You overpaid on the way in, and you lose premium on the way out. Most new investors never think about this. They focus on the price of silver, but ignore the cost of getting into it. Before buying any silver, ask yourself, how much of my money is actually going into metal? Maximize exposure to the move. Quick question for you. What kind of silver are you holding right now? Government coins, bars? Drop it in the comments. Now, if trap number 3 is overpaying for stories, and trap number 2 is overpaying for safety, trap number 1 is something entirely different. Ownership. Let's talk about paper silver. ETFs, digital silver accounts, anything where your silver exists has a number on a screen. No storage, no security concerns, no hassle. It's clean, it's simple. But do you actually own silver, or do you own a claim to silver? When you buy physical silver, you hold it. You control it. There's no middleman. But with paper silver, you're relying on a system. And in extreme conditions, paper and physical don't always behave the same way. The thing you can hold becomes more valuable than the thing you can't. So if these are the traps, what's the smarter approach? Focus on 3 things. Low premiums, high metal content, simplicity. Generic silver rounds, basic silver bars, nothing flashy, no unnecessary markup, just metal. Because in a bull market, you want to maximize ounces. A smaller group of investors, the ones who understand these traps, they move differently. They don't chase, they don't overpay. Before you buy silver in 2026, ask yourself, am I buying what feels right or what actually works?